Alright folks, high probability price patterns. Alright, out of all of the videos, I think the most paramount one you need to understand is the Power 3 module. And you probably have heard me mention this on so many different times, but it's absolutely imperative that you understand the anatomy of a candlestick or price bar. The relationship to the open to close is very significant also in technical analysis. I do have a handful of candlestick patterns that I like to trade with, and it's based on simple truths in the marketplace that I have faith in. And just like we have the bearish candle, the bullish candle is completely opposite. The low from open to low is where the smart money would accumulate, and the high to close is exactly where the smart money would distribute. And again, that may be accumulation at the low of new longs, or it may be selling of old longs at the high. But that's where the operating realm of smart money resides. And again, within the context of the high and the low, in between that body or range, that's the profit release portion. And again, all that is covered in the Power 3 module. It's very important that you visit that video if you haven't seen it yet. It's very, very paramount that you understand the principle in that video before we go into all of these things that we're discussing here. Now, as for candlesticks, there are a few I really like for confirming my trade setups and or entry and exit points. There are numerous supposedly able to pinpoint your trading to nirvana, but I only subscribe to the ones that I personally have faith in and go hand in hand with general market truths. There's certain generic principles that go along with successful trading, and it's hinging upon the notion of key support resistance levels and where smart money is going to be driving price right now, today, and into the near future. Okay, one of the candlestick patterns I like is the doji. Now, dojis are important candlesticks that provide information on their own. Dojis form when a asset's open and close are virtually equal. Now, the length of the upper or lower shadows or wicks can vary, and the resulting candlestick looks much like a cross or an inverted cross or a plus sign. Now, alone, dojis are neutral patterns, and any bullish or bearish bias is based on the preceding price action and future confirmation. Now, there's slight variances in the formation of a doji, and they're best seen at the end of a price swing or trend. Now, a doji star can be very strong as well. Now, I prefer a long wick doji, but their appearance alone is very useful. In the diagram we have here, we have a few of them, and some of the variances are a dragonfly doji, a gravestone doji, your standard small doji, and then you have a long-legged doji. Now, the bearish doji star, okay, when you see a very bullish candle, this is nearing the high end of a swing, if you are approaching like a pivot or a higher time frame resistance level, and you see a small doji form, okay, that's a doji star. It's very bearish, especially if the next candle gives you bearish price action. And the bullish doji star is obviously the reverse of that. We have a bearish move down, and then you have a small doji appear lower than the previous candle, and then you have the very next candle after that small doji forms. If it's bullish of any nature, that is confirmation that you may see price snap back and start to trade higher. Now, again, I like to look for these doji to form at the end of a price swing that I have either participated in or have been stalking for a new setup. So they're confirmations really of something that I've already anticipated based on key support resistance levels, SMT divergence, US dollar index, SMT, anything that goes along with a reversal of sorts. These candles are very confirming in that regard. Okay, one of the strongest candlestick patterns I like to use is the hammer. Okay, the hammer, or it's been commonly referred to as of late, they're called pin bars if you've been reading the forums, but I'm going to stick with the title of the hammer. Now, the hammer candlesticks form when a security or asset moves significantly lower after the open, but rallies to close well above the intraday low. Now the resulting candlestick looks like a square lollipop or a long with a long stick. Now if this candlestick forms during an advance or price rally, then it's called a hanging man. Okay, now that would look like this green hammer here. Okay, if price has moved down prior to that formation, that would be a bullish price swing, indication that we may be seeing a reversal. That long wick, I like to see that at key support resistance levels. It's very promising if we are anticipating bullish price action there. Now, if we're looking at that green candle or hammer here at the end of a price run up higher, okay, that's bearish, and that would be referred to as a hanging man. Now, the red hammer here, I like to see that at a high going into a key resistance level at the end of a price swing that's been anticipating a sell. If I'm getting short, I like to see that confirmation of seeing a hammer form. Like the optimal trade entry is one of the patterns I've been most known for in the last few years online. But if you use that entry technique to get into your trades, if you see a hammer form at the point of your entry, that is very confirming for your trade. And I like to see these patterns at key support and resistance levels, as well as my optimal trade entry points. And they really provide me confirmation of a trade that I may already be in. And I'll also refer to this pattern after the fact, as well, to establish a late entry in sync with the current market flow and/or direction. If you see a long wicked hammer on like an hourly chart or 4-hour chart, but you didn't really enter during that time frame, for instance, maybe it was a news event that took place, and you see a hammer in that time frame, whatever it's indicating, high or low. Obviously, for instance, if we look at the bullish hammer here, the green one, if we see that on a 4-hour or 1 hour, I would absolutely look for optimal trade entries to get long based on that formation there and try to reach for higher objectives, and vice versa, going short if I see a higher time frame intraday like 4-hour and 1 hour form in bearish hammer like this red one here. If that appears on your 4-hour, 1 hour chart after the fact, I'll still look for shorts to get in sync with that, especially around news events. If it's something that's like a keynote speech or FOMC rate announcement. Those two outside of non-farm payroll, I'm a little leery trading with. But if I see this happen after the fact, then obviously smart money has tipped their hand, and they're doing an obvious repricing, and I would look to get in sync with that. The tweezer low. All right, now tweezer low pattern is comparable to a very short-term double bottom. Now, essentially, the tweezers candles indicate that price has held twice at exactly the same level or low. Now, at the lows, sellers were not able to push the asset lower. Now, I really like to see this on a 4-hour and/or hourly charts at higher time frame support resistance levels. If it accompanies a SMT divergence, I will trade maximum risk exposure on that alone. It is a solid confirmation a significant low is priced in. The longer the wicks on these lows, the better. Trade set up with very long tweezer wicks at the bottom. Okay, so if I see that pattern occur at a key resistance, key support level, and SMT divergence occurs, and it's right time of day to be trading, wow, you can't get anything better than that. It's a very sweet setup. Okay, the tweezer high. The tweezer high pattern is comparable to a very short-term double top. Essentially, the tweezer candles indicate that prices held twice at the exact same level on the highs. Now, at the highs, buyers were not able to push the asset higher. I really like to see this on a 4-hour and hourly chart, much like the tweezer low, and if it accompanies an SMT divergence or optimal trade entry, that alone, again, much like the tweezer low, I would risk maximum exposure on that trade. It's very, very, very strong. Again, the longer the wicks, the more significant the confirmation it implies. . 。 . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . All right, one of my favorite candlestick patterns is the railroad tracks. Before I started using candlesticks, this was simply a key reversal formation on open, high, low, close bar charts, but it's very visual and very easier on the eyes and visual friendly by using candlesticks. Um, the railroad track pattern is one of the best reversal candlestick patterns you can discover on a chart. It actually signifies that the market makers have engineered a reversal. The fact that the asset quickly reverses direction and posts an equal, if not larger, subsequent candlestick is enormous insight. If there were only two candlesticks I'd trade with, it would be hammers and railroad tracks. They are that strong and that reliable. When they form at key levels, there's nothing easier to trade on. It's simple as that. Alright folks, we're going to look at a few price patterns in here. This example will allow me to show a wide assortment of price patterns. And this pair is actually the Euro Australian, and it's a pair I don't trade that much. I have traded it, but I don't trade it that much. To me, it's an exotic. But looking at price here, okay, and if this is what you were looking at presently, what could we discern from this? Well, we're going to look at the price pattern of the head and shoulders top formation. And a head and shoulders formation is typically found at a intermediate term high or low, or a long-term high or low. Okay, so generally an intermediate term high, that's where the high probability trade setups occur. If you are a student of my approach to market structure and looking for intermediate term highs and lows to trade from and nesting those out and finding long-term highs and lows, just focus on that concept and anticipate the formation of head and shoulders formations, and then you'll see that it doesn't sneak up on you. It's very easy to see. They don't just jump out after the fact. Alright, so we're looking at price has come off this high here, and we're trading at this present intermediate term formation in the market. We have a lower high here, higher high here, lower highs forming in here, so we have a head and shoulders formation. Alright, this being the two reference points here, and there's two ways you could draw this neckline. You can do this. You take this low to this low, and there would be nothing wrong with that. I'm getting a measurement from this high straight down till it touches the neckline. Should it at some point when you extend this line in the future, if price breaks down below it, okay, that's where you add the distance from this neckline to this high here, and that would give you a reasonable price objective once price, should it do this, break below that neckline. Okay, me being a swing trader and having a little bit more insight behind how price swings, I'm going to give you another way of doing it, but for now let's get some measurements on this so you can see what I mean by targets. Okay, we're going to take that high, draw down to the neckline, and just let go of it. Alright. Now at some point, again, if the neckline is extended, since we're in a general slope a little bit, you know, if it breaks out later in the future that's not being shown on the chart here, you know, this could be a reasonable objective down here, the 132 area. Okay, so let's just note that for a moment. We'll come back to it when we need to. Alright, and we're going to delineate the blue line as this initial move. Okay, so you can see price did meet that. Okay, now let's go back. Alright, now you can use that price swing and neckline break, or you can use this reference point and this reference point to be the neckline. Okay, and when price breaks out from here, obviously that's when you want to add the range. But now let's use this same level. Notice how it's different. A little bit more price movement we got to catch by drawing it down to the neckline. So you just catch that point, drop it down on there. Okay, and now we're going to take that point at which the neckline's broken, which is here. Okay, and here is the level, which is 131.87 area. Okay, and you can see clearly price did meet that objective. All right, so you can see that there's significant prognostication found by using the head and shoulders formation. Again, forming at intermediate term highs or lows and long-term highs and lows, and this being the top formation. So this head and shoulders is a top formation or a selling pattern to get you in sync with the higher time frame premise for price moving lower, and also it lends very well with the market structure concept that I teach. Alright guys, this is a climax reversal pattern, and it's I learned this from the Street Smarts book, and I would recommend that book. You'll find that that book is referenced at the end of this video for additional reading and reference among other books. So real quick, the way it works is you want to see clear 1, 2, 3 drives higher. Okay, real sharp drives. Now you could use this one here as 1 instead of this one here, so it could be 1, 2, 3, but I like them when they're tighter like this. It's 1, 2, 3. Okay, and that's a reason why they call it the 3 Indian pattern. I didn't come up with that cute little name. It's just that's what the book referred to it as, and giving credit where credit's due. That's why I'm using it, you know, as my descriptor here. So we have 1, 2, 3 highs here. Usually, if that hits an area of resistance, and we're just going to put up a macro on the pivots, and should price meet, which we do here, R2 level coming in at 138.39, you could sell into this, especially if you have other kind of momentum divergence, which we're not going to add to it here. We're just looking at price action patterns. We could reasonably expect price to reverse here. Now you can do several different things. You can look for a lower time frame. This is a 1-hour chart here. You can look for a lower time frame optimal trade entry into this point, or you could sell a break below this high here. Okay, and right there is where you would see a optimal trade entry on a lower time frame. Then you see your price slide lower. Okay, so there's your climax reversal, 3 Indian top. Alright guys, we are going to cover an ascending triangle. Okay, an ascending triangle could be seen by noting this key resistance level. Okay, higher here, finding some consolidation and support resistance in here. Note also that we have this. Okay, so you can see how we have an ascending triangle formation in here. Now obviously you can draw it much larger ascending triangle. One could do this and use this as an errant wick or violation of a general trend line, which I don't like trend lines, but if you're going to use this, you would take this low straight up to this level here being your measurements for expansion. Once this level is broken, if price makes above here, as we do here, we could reasonably expect to see price trade up, you know, considerably higher based on that. Now that's a very large triangle, and there's nothing wrong with saying that it could happen on a long term, but I'm more of an intermediate term swing trader, short to intermediate term, so I would use this triangle ascending triangle formation in here, and you get your measurement from the low, draw it up to that level here, and I have to change that back to a segment, not array. Okay, so there's your price range. Okay, and that equates to a pip range of approximately 340 pips. Okay, now the way I use it is while I'm in a buy program, and this is a continuation pattern, so bullish ascending triangles, I would take the widest portion of the triangle that I've noted, and every time there is a buying opportunity, I would simply just add that pip range to the low. Okay, so here's a low that's bouncing. Okay, I would reasonably expect to see price trade up to here. So we're going to note these levels as we go. Okay, here's one price objective on the upper side. So if you like scaling out of your trades, this is one way of doing it. Here's another opportunity where price had meted the low and started trading higher from. And we'll note that. Okay, and obviously we have to take in consideration the actual break of the resistance on this pattern, and then using the upside objective for that. So this level here being the resistance or top of the triangle formation, we're taking the range, adding it to that level up here. So let's note that. Okay, and now we just simply take a look at what price actually did. Now let's walk forward. We have our levels where we reasonably expect to take some profits, scaling out of our long-term intermediate term trade, going long in the Australian dollar. Okay, you can see price met that first objective right there. And the second one, it met it. And the third level being just a little bit above us now. Was met right there. So you can see how using these price patterns, they're very basic and classic by nature. They give you very clear levels to anticipate and take price objectives and scale off your profits. Now, obviously, the price of the pair kept going higher, but you can see clearly how we had very discernible levels to take profits at. And notice that we added these levels based on the swing from this low up to the implied resistance level or top of the triangle, and then added that range to the low, and then to the highest portion of the triangle formation itself, giving us these objectives. You can see how we had implied support and resistance in here based on that level, implied support and resistance in here. Okay, very nice reaction there. Implied support and resistance level in here. Okay, and we have since moved a little bit higher, but eventually have broken away. Now let's look at what we were able to discern on those previous levels. Let's see if it arrived at that same. Okay, here's what we did. We added to the low here. We added to the low here. Okay, if you add it to this low in here, you get that level right there. If you add it to this low here, okay, you get this level here. Now if you add it to this level here, fell just a little bit short of it, and then ultimately we slid down. So you can see how it gives you insight and gives you reference points to base your swings to and from. But that's how I use the ascending triangle formation. Alright guys, we're looking at the Australian dollar. This is an hourly chart. This is going to be an example of an inverted head and shoulders bottom formation. Okay, and these are going to occur at intermediate term lows in the market or long-term lows in the marketplace. Okay, we have a low in the price. We have a lower low in price. We may be seeing the formation of an intermediate term low or long-term low in the marketplace. Okay, we could see this neckline here. Okay, let's draw that out. Okay, so we have the left shoulder, the head, and the right shoulder. If when price breaks above the neckline, which it does here, you always have to reasonably expect a retracement back to the neckline. That's always a classic in head and shoulders formations. I don't necessarily need to see that because I really want to be trading into this shoulder. Okay, so in other words, as price is trading down, I'm going to be looking for optimal trade entry in this area here, or in a lower time frame, something like that. But the price eventually trades considerably higher, and there is the completion of the inverted head and shoulders pattern. Obviously, looking from the neckline to the low or head, once it breaks, you would get a reasonable price objective. But again, they're just initial price objectives, and they are much of the time very insignificant in terms of the grander price swing that actually unfolds at these levels when you do catch a long term low or intermediate term low on an inverted head and shoulders formation. Alright guys, we're going to look at bull flags, and this is a bullish continuation pattern. And the way it looks is we have a flagpole, as it's referred to in classic definition. Okay, that would be this swing here, and the flag portion of the pattern would form something like this. Okay, so we have a run up in price, then we consolidate and go lower. Okay, so this is kind of like a spring effect, a wind up before a release and snap higher. Now obviously this is based on a higher time frame bullish scenario. Okay, so what you would do is you would take that low to this high, which is here, then you would add it to the low of the flag to give you your price objectives, that being here, or you can add it to the breakout above this level here, giving you a little bit higher price objective. Okay, now when you're using these patterns, always look to the left, and you can see there's a significant long-term, intermediate-term high up here. So even though you have the targets up here, you really want to be looking to take some profits on these patterns, simply because that you may see this pattern fail. Okay, just because they worked in the past doesn't mean they're going to work in the future. Okay, so price eventually starts to move higher. And you can see price met both objectives and continued to move higher. Now, you can also note that they have a bull flag here, price run up, the flag formation in here, and then take this low to high, add it to the low here, and you'll arrive at a general idea where this market would reach a upper price objective. Okay, so that's an example of a bull flag and how I use it. Alright, we're going to look at a bear flag. This is a continuation pattern that's bearish by nature. Okay, and you want to look for the flag pole, which is again the classic reference to the swing that you move away from. And then you want to see the flag formation, okay, which is this, okay. So you have a price down consolidation or little tiny little range channel type thing. It's a retracement, but it's tight. It's very, very, very tight and consolidated. And then when price breaks down below this level here, or when you identify the high it forms in the flag formation, you use your pole and you add it to that high. So you're going to get a subtraction by this range from that high down to the lowest portion of the pole. You subtract it from the high, and that'll give you this price point here. So let's note that. Or you can use the break below the flag support, which would be here, giving you a little bit lower price objective. So let's note that as well. And this is a 4-hour chart, by the way. And you can see, let's take the pole projections off. The first objective was met at 136.60, and price ultimately went right down to, you can see how many times we bounced exactly at that level we used from projecting, and then consolidated and then slipped below it. But look at the implied support and resistance levels, okay, that was just created by simply taking price action alone. No pivots, no longer term higher time frame support and resistance levels, just understanding how price behaves and its swing nature. You can see how it's absolutely beneficial for you to understand how price moves in classic chart formations. And this is how I use the bear flag formation. Alright guys, we're going to look at a coil. Okay, and a coil is when price enters a very tight consolidation. As we see here, see how price is winding up tighter, 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 and we're in that smallest little tiny portion of this coil. Okay, that is going to be a huge red neon sign flashing on your screen that we're going to see in expansion one direction or the other. Okay, and this is how you have to use your higher time frame analysis to get in sync, because coils by nature are just a volatility pattern. Okay, they imply a significant increase in volatility that could translate to a move lower of significance or a move higher of significance. Okay, so you have to use the higher time frame directional bias for you to be able to discern the direction. But this highlights a pattern of consolidation, which tightens up the narrow ranges, and when you get small ranges, what comes afterwards, it's going to be large ranges. Okay, and this is a 1-hour chart, and you could look at several ways of doing this. You could take this low here, okay, and everything on a coil to me is symmetrical, so I'm not going to use this point back here. I'm going to use the low and go straight up until it touches here, okay, and that looks like this. Okay, so if we break above, okay, I'm going to reach for this high here. If we break below, and this is if this was bearish, I would reach for this level down here. Okay, but as it stands, long-term support, this being bullish, the higher time frame suggested that this was the upside objective, and when price did finally break from its constraints in this coil, you can see how price violently rode up to our price objective. Okay, and that equated to a potential range of 245 pips. Okay, so not bad using a simple classic pattern, the coil. Alright guys, we're going to look at turtle soup. Okay, turtle soup is another pattern that I gleaned from the book titled Street Smarts. Again, you can see it. The title and author is credited at the end of this video presentation. Alright, the way this pattern works is it capitalizes on the notion that the turtles, like many of you probably already understand, that there was a group years ago that was nicknamed the Turtles. And what they were they were long-term trend following in nature, and simply they just bought 20 high and 20 low levels. In other words, the highest high in the last 20 days, if price broke out and went higher, they would consider that as a significant breakout, and they would be long. And they would hold on to that position until eventually it stopped them out, and vice versa. They would sell short 20 period or 20-day lows. When they were broken to the downside, they would be considering that a significant breakout, and they would stay short until they were stopped out. And they had a lot of losses, but their risk management and their money management allowed them to stay in the game long enough. And when they were right, they caught huge, extrapolated huge trends up and down in the marketplace. And this pattern here, because their pattern of trading lost more than it won in terms of frequency, it capitalizes on the fact that it is many times a false break when it's a 20 period break above its high. Many times it'll retrace back into the range, or if not at all, reverse altogether. Vice versa, if you look at a 20-day low, many times when price breaks below it, it's a false break, and then it'll trade back up into the range, if not reverse altogether. Alright, what I did was here, I delineated the month with a period separator. Okay, and it's just going to make it easier for me to call out 20 period highs and lows, because we're roughly looking at 20 periods of trading between each vertical line. So it'll help you eyeball it too when you do your own analysis. Just real quick, I'm not going to beat this into death, because you can see a lot of examples in my church. I'm not going to beat this to death. A lot of examples materialize in my videos. So just go through some of my Pro Traders Club videos and my market review videos, and you'll see a lot of this discussion on turtle soup formations. But the salient point is basically we have a low here, a low here. Okay, so if you were trading this, when price trades below this low here, this would be the lowest low in the last 20 periods if you were looking at this time frame right here. Okay, so let's zoom in. It might make a little bit better sense to you that way. Okay, if you were trading on this day here, price, when it broke below this low, if you count, okay, go back 20 days, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. The lowest low in that range of days is here. So when price broke below it, okay, you would be looking to get long on the notion that it's a false break below it. Okay, so on this day here, price went below, you would look to get long, and you can see how price broke back up into the upside and did not go lower. Okay, an example of a turtle soup sell. Okay, we're going to see this high here, and it's obviously it looks purely like hindsight, cherry picking, but I assure you I trade this pattern a lot, and it's very frequent. It happens a lot. But the highest high in the last 20 days from that point is this high here. So when price broke above it, the turtles would be long here, trend following, okay? But you can see it only went up above it just a little bit and then violently pulled back into the range. All right. Another example, okay, when we were trading up these levels here, we're above this old high here. Now, going back, this is the highest high in the last 20 days, so this was all a fake out, okay? This is a fake out. So all this price action above this high was pairing orders, allowing those suckers to get long, and then they pulled it back into the range. Here's a 20 period low when price broke below it. Here, false break below it, shoots back up. Okay. 20 period high here. Price breaks above it just a little bit. False break. Short it. Okay. Now obviously this is a daily chart, so this is like a stage that gets set for looking for extreme reversals in the pivot sell region, an optimal trade entry, a Judas swing. There's a lot of ways to add, you know, accuracy in terms of actually trading it, but the turtle soup pattern on a daily chart really sets the stage for really nice reversal setups. Here's a 20 period high that was seen penetrated here. Okay, we had a couple days where we stayed above it, but then eventually snapped down. You can see just by a few pips, not very many at all, violently pulled back away from that low. All right, let's look at turtle soup on an hourly chart because this pattern is universal. You see how price traded above this old high in here, quickly reverses. Okay, now you can sell right into that resistance level. That's the turtle soup entry. Or if you're more conservative and you want to see more confirmation that you may be in a sell setup or a climax reversal, when price trades up and pulls away, wait for the optimal trade entry to form, which unfolds here. Again, this is an hourly chart, so you can use the turtle soup to set the stage for a optimal trade entry, which is here. And if you miss that one, just use this reference point here, and here's your optimal trade entry also, and then you can get short. And if you miss that one, you can get into it here before we see the precipitous slide lower. Okay, so that's turtle soup on the hourly chart. On a sell side, you can see it unfold in the form of a buy. You see the false break below an old low here. Okay, and trades back up into the range, and just by trading that, the range was 262 pips, so even if you got out at 100 pips, you know, there's nothing wrong with that at all. But that's how you use the turtle soup pattern. It's a false break above a previous high or low, and we use a 20 period range for determining what the actual high or low we're going to be referencing. If you have a much wider spread between the significant highs or lows, like for instance this one here, if we're looking at this, obviously we can't go back 20 periods because 20 periods back, the lowest low would be something like this, and that doesn't suit our stalking as it relates to this pattern. This low breaking below this low here is more like, or more correctly referred to as a riptide reversal. Okay, so in other words, we have a significant low, we've traded some time away from it, and then once we broke below it, okay, the riptide reversal is we'll trade back away from that broken low. Many times you'll see that unfold as a intraday price reversal based on significant highs or lows, and that's how this pattern is traded, not on a 20 period basis like the turtle soup, but riptide is any significant high or low broken and rejected, that's where we have the reversal pattern unfold as a riptide reversal. So for clarity's sake, turtle soup is using a 20 period, whether it be daily or intraday, of any time frame, going back to last 20 periods or 20 bars or candles, whatever the highest high is. If it goes above that and fails, that's a turtle soup sell. If it goes below the lowest in the last 20 periods and fails, that's a turtle soup long or buy. The riptide reversal is when you use a significant swing high or low of any distance of range. In other words, it's not limited to 20 periods. Okay, it could be 50. It could be 100 candles between the two. There's no real reference point except for the fact that it's a significant high or low that's violated by a few pips, many times just by very few pips. And if there's rejection noted, there's your riptide reversal. You would just get long. And I know it'd probably be very scary to many, buying into something like this, but you got to go back to the left side of your chart, as I note always, that there's a significant low down here, and there may be just a run for stops, and they pull it back up into the range. So that's riptide reversal. Alright guys, we're going to look at reflection. Okay, reflection is the anti-optimal trade entry. Not that it's not optimal trade entry, it's just the mirror reflection of what you understand as a typical optimal trade entry pattern. Okay, what it looks like is you'll have a low, and then price will drive lower. This is a buy example of reflection. Okay, notice how we didn't get an optimal trade entry from the low here. Okay, we didn't see any retracement back down to a 62 or 79% retracement level for a sweet spot to get long and continue on higher. Okay, and you've probably seen several opportunities like this pass you by. But if we're looking for a significant price reversal, I grabbed that line, didn't need it. Let's just put that up there out of the way. This is a significant low here. Okay, so when price trades down through it, okay, we would be looking for, number one, riptide reversal, turtle soup type formations. Okay, in other words, a false break below this low here, and then look for rejection. Reflection, okay, is an optimal trade entry just reversed. All right, now here's what I want you to look at. If you could take this price swing here and here and reverse it, just swing it from the left to the right, this would be optimal trade entry if it was occurring on here. Okay, so let me illustrate that so you can see what I mean. All right, here is the 62% retracement level, the 79% retracement level, and that sweet spot right in here. Okay, using this swing here. Now, if all this price action occurred on the right side of this down move, this is what you see as your typical optimal trade entry, and your entry pattern would have been something like in here. Okay, all we're doing is imagining from right now, for lack of a better word, if this is reversed and this action was over here. Okay, that's your typical optimal trade entry. All right, now I see, when I look at price, I see when we have a significant price level of importance like we have here and price trades down, many times I'm trading right into that break below that low in the hopes that that's a rate on stops. How far do I go down in terms of reaching for the entry pattern, okay, is noted like this. You take the low prior to its move down up to the high, okay, here's the 127 extension. So I'm going to be buying the 127 extension with the premise in mind that the optimal trade entry may not form over here. Okay, so you can use this entry pattern to get long, scaling in your portion of your trade. In other words, if you think you're going to trade 2% risk, all right, let's assume for a moment you're going to be getting long on the cable. We're trading down into a significant low. You think that there's stops under here. Well, you buy below that low at the 127 extension based on the prior swing that made the move lower. Okay, you buy 1% of the position here. Then you can wait, and if price moves back above and then trades and gives you an optimal trade entry, you can scale in the other remaining 1% of your position if you're going to be risking a total of 2%. But here's what you'll have. You'll have a position down here put in, and you also have another portion in here. And you just let it ride to whatever your price objectives are. But the reflection pattern is simply taking the low to the high prior to the move down. Okay, that would create your typical standard optimal trade entry long. It's just a reflection of what that would look like. Okay, and you can see by basing that low to high, okay, the 127 extension, that's where I'm going to be buying when it lines up a move below a significant low. So that's reflection long. Okay. You can also look and measure once you plot this like this. You have the high and the low. You can pull the fib. Now, well, I'll have to show it to you in a second. Okay, I can't point with the mouse and talk at the same time. You can pull the fib. Now, what I did was I kept the fib on the high, and I pulled it away where here's the 62% retracement level and the 79% retracement level, and I put the low that I pulled the fib from on this point, this reference point right here, I put that right in what the implied sweet spot would be. So here's the 62 and it's 79% retracement level. I just laid it in there eyeballing it, okay, and you can see how we nailed the actual low of the day, and then it finally made up. So that's reflection. Alright guys, this is an example of reflection on the sell side. Okay, we were reasonably expecting a push to the 161 figure here. That's a level you'd be watching anyway. Okay, so that's why we're noting this one. Okay, and notice how before we had this nice slide down here, there was no optimal trade entry. No optimal trade entry, okay? But now let's look at what we got. We have this high prior to the move that we're looking to sell into. Pull a fib from it down, and the 127 extension is here. Okay, so that's the level. Just by using this to high, pulling the fib down, the extension 127 is where we'd be reasonably looking to sell short. Okay, but now also look, we have the 62 and the 79% retracement level. What I'm going to do is I'm going to grab that fib right here and I'm going to lift it up, and what I'm going to try to do is I'm going to put this high between the 62 and 79% retracement level at the sweet spot. Okay, and watch what happens. So here we have the high that we pulled the fib from for reflection. Okay, all this is a mirror reflection of what a perfect optimal trade entry would look like on the other side of that high if we were waiting for it to form, which it didn't here. Reflection is a mirror image. Okay, if you could take a picture of a chart, print it out when you have a perfect optimal trade entry, hold it in a mirror, and this is what you would see. That's why I refer to it. I named it the reflection. And this is how you nail the actual high, and you would know this price level. Okay, you would know this price level when price was doing that. Okay, in other words, you would see just this. Okay, this move down. When we're trading up into the fig, how far it's going to go up. Well, you pull your fib down. This is your level you're going to be eyeballing. First target of looking for a sell point. Then you just pull your fib up until it sits inside of the sweet spot. Here's the 62% retracement level here, the 79% retracement level, this level right up here. Now you just wait for price to trade right up into that level. Okay, and then boom, reflection. Okay folks, we're going to look at another pattern that I gleaned from the great work of Larry Williams. This is a very old pattern, way back in his early work, but it's a dandy. Alright, what this is an outside day with a down close. Okay, we're looking at a daily chart. This is the fiber Euro USD pair. Okay, and what is an outside day? An outside day is any day that has a higher high and lower low prior to the day before. Okay, in other words, today's high, if in other words, today the market closed and we started a new trading session. If the high that was formed yesterday was higher than the day before and its low was lower than the day before, that is an outside day. Okay, and what does it look like? Okay, how can you find an outside day with a down close? Well, here is an outside day with a down close. Okay, this day prior to it, its low was broken, its high was broken. Okay, so now we have a outside day with a down close. That is a bullish scenario, very bullish scenario. By itself, okay, by itself it doesn't mean anything, but when you add to the fact that it occurs at a time when we are oversold, which we see here, okay, so technically by all standards we would be considered oversold. And then we have a technical pattern in price on a daily chart where we have an outside day with a down close. The next day I would be looking for a Judas swing down and then look to go long, or look for optimal trade entries in the kill zones to get long, and look for range expansion going upward. Okay, another example of an outside day with a down close. Here we have a daily range that was violated on both aspects of its high and low. Outside range, its low is lower than the previous day, its high is higher than the previous day. The down close, very next day, look to get long. Okay, look for Judas swings down or optimal trade entry buy signals to get long. Okay, when we are oversold, again, the percent R is in its oversold region. And just for clarity's sake, I'm sure you probably have seen it in other modules, but I use this 30 and 70 as my parameters on all of my momentum indicators to you determine what overbought or oversold is. Alright guys, now we're going to look at an inside day. An inside day is the counterpart to an outside day. An inside day is a day that has a high or low that's less than the previous day. In other words, this day here, it has a higher low than the previous day, and its high is lower. Okay, and we have an inside day here with a day with a higher low and lower high than the day before it. And usually when you see this, this is an indication that we're going to see a trending day or a large range expansion day, and you see that unfold here. Okay, so if you see inside days, that's a red neon sign for you guys to get ready for a range expansion day.